Hey everyone, thanks so much for coming on to our presentation. As I was saying earlier, I'm really excited about this one, brand new presentation just put together. And thank you everyone for also for those that signed up for last week, but then I pushed it to this week. I really wanted to make sure that I had a strong presentation to give everyone because it's something that I've been thinking about um, over the past year about this topic. And I see some tremendous opportunity. So basically, we'll introduce ourselves, talk about historic. Actually, there's my first error right there. Not historic interest rates, historic exchange rates. It shows you how we generally think in interest rate, but historic exchange rates. Talk about the current condo market, future supply issues, and compounding to leverage the gain. Um, just to let everyone know, we've helped over 1,500 people from across Canada uh, uh, to invest and buy investment real estate. This is what we do full time. We help people build wealth through the investment of real estate, and we are all active investors as well. So my name's Alex Wilson, owner and broker of record of Remax Wealth Builders Real Estate. I've been selling real estate for over 15 years now. In 2022, I was recognized as the #1 Remax agent in Canada, and we just got the stats for 2024. I was recognized as #2 agent for closed transactions for Canada. So I'm slacking a little bit. I apologize to everyone. I'll be better in 2025. Also been inducted in the Remax Hall of Fame, achieved the Remax Lifetime Achievement Award at 35, and received Remax Circle Legends at 40. But what I'm really proud of is my investment real estate that I've done. And I've turned a $39,000 deposit, similar to Kyle, because we both bought our first piece of investment real estate at the same time in the same building. Turned that $39,000 deposit into a $17 million real estate portfolio. And that's everything right here. And it goes to that point where when we're in our general chit chat earlier, you got to take a look at things and look at them over the long term. The market is down right now, but I know why the market is down. The market's down is because we just went through the highest increase of interest rates in the shortest period of time ever. We've never had interest rates increase that quickly, not even in the 80s. And now we're on the downward side of that. So that's number one reason why that happened. And what did that lead to? Well, that led to a lot of individuals, investors listing their property on the market because they were cash flow negative. And at the same time, you had a number of properties coming onto the market because you had condo completions completing. And I'll get more into how that turns into a supply glut right now to supply scarcity in the future. It's just you got to look at the picture a little bigger and not focus on what's today. And then on top of all that, so you have landlords listing their properties for sale, you have builders completing buildings, and then because of the high interest rates, people couldn't qualify for mortgages. So what happens? You have an increase in supply and a decrease in demand, and you have pressure on pricing. But that is reversing now. And that's where we got to look at the long-term picture on everything. So when I look at the long-term picture, today market value of my portfolio is 17 million. But when I look at the market value of the portfolio in 30 years, it's worth 42 million. And the key thing is that today that 17 million, I don't have $17 million. If I were to sell everything, I definitely wouldn't have 17 million because there's mortgages on all these properties. But there's tenants in all these properties. And over the years, the tenants are paying down the mortgage balance on the property. And then in 30 years, I will have $42 million because all the mortgages would be paid off. And this is calculated at a very conservative 3% compounded annual growth rate. So don't worry about what's happening today. You got to look what's happening in the future, because when you look over time, it's going to smooth out those dips and peaks in the market. Now we have Kyle.
Hi, everyone. My name's Kyle Dovigi. I'm a real estate broker, licensed in Ontario and Alberta. I've been an investor for over a decade, and I now actually have 9 properties. I recently added 2 more since the slide has been updated. But I didn't start in real estate. Before this career, I actually managed the national lotteries, Lotto 649 and Lotto Max. So I was actually running the draws. And during my time there, a scary statistic came out. and it was saying that about a third of Canadians were planning on funding their retirements by winning the lottery. Do you know the odds of winning the lottery? That is not happening, not even close, not by a mile. So Alex convinced me actually to switch into real estate. He knew I was really passionate about that and to help people build wealth by investing in real estate. And since that time, I've helped over 500 people across Canada to invest in pre-construction properties and to start their real estate portfolios. Similar to Alex, I started my portfolio with just one deposit of about $38,000, and I've built that over a decade into a multi-million dollar real estate portfolio as well.
And I want to add the two properties Kyle added. Kyle, didn't you buy those properties this year?
I did, yes.
Yeah.
So
So
still adding to my portfolio in
adding
this market.
in this market because it's realizing where opportunities are, and there are opportunities in the market. And that's again looking at the big picture. You know, there are things that make sense out there, and you're going to see as I show the big picture, going, hey, here's where exchange rates are, here's where supply issues are going to be in the future. You know, established investors are still adding properties right now. And there's Kyle's portfolio, not including the other two that he just recently added.
Correct.
Again, Nish.
There we go. Thanks, guys. Nish Dissanayake here. I love to lead my component of the presentation by also relaying that I'm an investor myself. A total of 9 properties, 7 of those are outside the province, 2 of those are in Ontario. My first investment was almost 20 years ago now that I do the math. So definitely looking back, it was a wise decision. However, my journey in the real estate space as an investor or as a buyer was purely for a place to live. I didn't really focus on the investment side and how I would truly be able to use real estate to secure my financial future until I started to get into the business and working closer with Alex and Kyle. My real estate journey began at the end of 2020. Really, 2021 is when I began to do active trading in real estate. And, you know, I've been very fortunate to be recognized within the 1% of realtors across Toronto, TREB, which is the largest real estate board in, I think, in Canada, for the past 4 years now. Along with my resale business, I've also done a ton of pre-construction sales out of province and within the province. And prior to that, I was in a sales and marketing directorship position in the corporate field. One of the biggest takeaways for me working in that environment and then coming over to real estate is really looking at how so many people, as Kyle mentioned, rely on other factors for their financial future. So many of my colleagues, when our business shut down as a result of COVID, they didn't have a path forward. Their financial future was not secured because they were depending on the company that they work for to help them with their retirement. And all that disappeared. So we were able to really switch gears as a family, invest in real estate to secure a financial future. And now I have 6 properties that have tenants, 2 more coming at the end of this year and next year. And just truly looking forward to see what this presentation is about today. And I don't know. Oh, Alex, you added that last part. Hall of Fame member as well. So another 3 years.
So congrats, Nish just inducted into the Remax Hall of Fame. Kyle hit it at 20 in 2023. So both of them in under 3 years, huge, tremendous sales success. So congratulations, guys.
Thank you.
And there's Nish, but again, we're all about transparency because we want to show people we buy, we invest, and we hold.
Exactly. I'm not too sure why some of these are highlighted, probably from a different presentation, but here's the portfolio. Yeah. Current market value is just under 5.5 million, but applying that same 3% year over year appreciation, you know, looking at almost $13 million just as it stands right now over the next 30 years. And that's not including the principal pay down either. So there we go.
And for the slides, I do the slides, and I'm grabbing presentations, that kind of stuff. So for Nish and Kyle, you know, if there's something that's missing from the slide, it's all on me, because when I get into my mode and I go into my close my door in my office. I'm creating these things, and I don't always use the right slides on the beginning part. So let's get in again. I did it again. Historic interest rates. It's not historic interest rates. It's historic exchange rates. So let's go to the relevance slide here. So when you look at the Canadian US exchange rate history, so to give people a background, when I went to university, my background is in economics and finance. So that's where I look at a wide range of different categories and how it's going to impact the market. And when you look at the historic exchange rate, the average exchange rate over the since 1975 is actually 80 cents. And today we're at around 70 cents. When I say today, that was as of yesterday. Who knows what it is today in regards to how the media impacts things, but we're hovering around 70 cents to the American dollar, and the historic average is 80 cents. And when you get into that 80 cents, that 69 cents, you're actually in the low area of where we've been trending. So this graph ends in March 2024, and that number there, that last point on that graph is actually at 74 cents. So we're hovering actually lower down here to that valley right here where we were in around early 2000s. We're in that range of 62 to 70 cents. That's where that low valley is. And when you look historically, we have had areas where we've been above par. So par being is a one, par means one Canadian dollar to one American dollar. So that existed in the 70s, that existed in around 2026, 2027. That existed in 2010. So we have these peaks and these valleys that happen. We are in a valley period right now. And if you look at the history of exchange rates, we hit a peak, then we go down to a valley. We go back up, we go back into a valley. We go back into a peak. This drop right here, that's the financial crisis right there. And then you go, and then you back up. And now we're back into a valley again. And what's going to happen is that we're going to go back up again. We know that historically the average is 80 cents. We're in a valley right now. And when you factor in looking at the exchange rate, if you're holding American dollars, so if you're an expat, for example, and you're living in the US making American dollars, or you're working in the Middle East, you're working in Dubai and you're making American dollars, or you're living in Hong Kong and you're making American dollars, or you're living in Singapore and you're making American dollars. The American dollar is quite high right now, historically against the Canadian dollar and other currencies as well. So this is the time that the power of the American dollar will go down. You know, that's what history is telling us. The power of the American dollar will go down. And when the American dollar does go down, that makes your currency more valuable. So if you're holding American dollars to hedge the currency, you're going to want to buy currency back in another country. And then what you can do is then you can put the money into real estate. And why I like real estate is that real estate pays me a return by holding it. What do I mean pays me a return? It's just simple. I provide a roof over someone's head and they pay me rent for that roof. And where I see the attractive point is that we're dealing in a situation historically, we're in a valley for where our exchange rate is with the Canadian dollar to the American dollar, plus real estate values are down and they're suppressed too. And we're going to get more into that, showing that. So it reminds me a lot of around 2010, 2011, but reverse, when what you had here is when we had the financial crisis, 2008, and the Canadian banking was so strong that we rebounded very, very quickly, where what you had in the US, you had a dramatic drop in housing prices because the housing market crashed. And then you had a dramatic devaluation of the American currency at the same time. So you had the double whammy in the US. And if you had Canadian cash at that time, the best thing you could do was go buy a piece of American real estate. Because you knew that historically the Canadian dollar wouldn't stay at above a par or at above. We knew that we would regress to the mean. Also, we knew that American real estate prices would eventually go back up again. So you were at historic lows on American real estate values, and you're at historic highs for the Canadian dollar to the value of the American dollar. Problem was, in that time, I had no money. So there was no way that I could go to the US and, let's say, pick up a property in Florida for $150,000, because that's what you could do back then. Because at that time, you'd have to pay all cash. And at that time, I didn't have $150,000 Canadian. I probably had, like $25 Canadian. So I didn't have that option, but I saw that opportunity, and that's always rung in my head. And now I see the reverse side of that, going, okay, well, look, we're in the historic low period of the value of the Canadian dollar, the American dollar. Oh, and guess what? We are in a situation where we've seen a 20% drop in prices as well in the Canadian real estate market. I see opportunity. So what I want to point out is why the American economy, a big reason why the American economy is so strong right now, and the rest of the world is, again, there's a spelling mistake, weak, but the word weak instead of weak, weak as WEAK. Their mortgages are different. So the US is the only country in the world that does this. So US mortgages are 30-year mortgages, unlike the rest of the world. Therefore, all their home buyers are locked into pandemic rate mortgages. So a lot of the headline news that you hear is that, whoa, we have all these renewals, and people in Canada where they were locked into 1.5% or 2% mortgages, they're renewing into higher mortgages today. That is not happening in the US. Because they lock into 30-year terms. They don't have the 5-year, 10-year terms. They lock into 30-year terms. It also means that their mortgage rates don't go as low as ours either. So the average rate for that time for a US mortgage during the pandemic rate mortgage was 2.95%. So the Americans are all locked into 2.95% mortgages right now. Americans do not do floating rate mortgages, i.e. variable rate mortgages. So they don't, like where we go for a variable rate mortgage, they're not doing it. They're locking in for 30 years. Now, what you got to factor in, the American domestic consumption makes up 69% of their GDP. We're 54%. So why all this matters is that when you had this dramatic increase in interest rates to decrease inflation, that significantly impacted the Canadian disposable income, because we had to go pay more money on a monthly basis towards our mortgage. The Americans didn't have any of that because they don't have floating rate mortgages, and they're not renewing on their mortgages. So the increase in interest rates had zero impact on their disposable income, because their rates are all locked in on their largest debt, which is their household debt, the mortgage on their house. So that allowed their economy to continue to be strong, which their 70% of their economy is domestic spend. So you could continue to have strong spending through that period. Whereas the Canadian economy, wow, my mortgage rates doubled in a period. Oh, shoot, I got to cut back significantly. Now, this is where the turn comes into play. So you guys, US mortgage today, 6.84%. So if you were to buy a property in the US, 6.84%, that's what the mortgage is. That was last year for us. We're already past that. And it's expected to stay above 6% throughout 2026. With their strong economy based on domestic consumption, the Federal Reserve cannot drop interest rates. It can't. It's not happening. So they're going to be at 6% mortgages throughout 2026. In Canada, you can get 5-year mortgages as low as 3.84% right now. That's an insured rate mortgage, 3.84%, and expect our variable rate mortgage to 3.5% by the end of 2025. As I said, Americans do not do floating rate mortgages. So we're only looking at a spread at some point this year of 0.55% between the Canadian mortgage rate of 3.5% variable rate mortgage to the American pandemic rate of 2.95%. So on our largest debt, of households, we're actually going to get back to closer to where the US is and what their monthly payments are. Now, this is where you're going to see a change. New home sales in both Canada and the US are at 30-year lows. So buyers aren't buying new homes right now, not in the US. And why aren't they buying them in the US? Well, like that's 6.84%. The buyers can't afford to buy new homes. So you're at lower rates. Why are new home sales at 30-year lows in Canada? Well, we were just at 6.84% last year, but interest rates are now going down. And what does that mean? With interest rates going down, in the second part of this year, we're going to see activity pick back up. When we see activity pick back up, we already see on the freehold market, activity is already picked up. Condo market, we have excess inventory, but as interest rates go down, that excess inventory will get eaten up. And then we're going to have a pickup in new home sales, because once we drop into get back into a buyer's market for real estate, which again will happen at some point later this year, second half of this year, could be third quarter, fourth quarter of this year, that happens, then you'll start seeing new home sales start pick up. And what happens when new home sales pick up? Well, that means construction activity will start to begin again. And what happens when construction activity starts to begin again? That is a positive stimulus towards our economy. It's when you take this bigger picture and look at the impact of various factors in our market. So let's talk about the depressed market today. So when I look at the opportunity here, we looked at where the historic interest rates are. Now we're going to look at the pricing in the GTA market. So this graph here, I thought was an incredible graph. So focus in on the orange line. So the orange line is the average increases that we've been experiencing since 2010. The average increase in the annual price. So if we look at from 2010 to 2020, and if we ignore the peaks, we're looking at roughly about an average of 7% growth. There was nearly a 20% jump in 2010. Then we saw a big jump in 2017. Then we saw a dip after that. Then we saw trending again in regards to around that 5%, then starting to go back up. Then we hit the pandemic, boom. And then where we are right now, since 2023, is no growth in pricing. So no growth in pricing. But if we notice at the chart where we'll say where we're flat, then we go back up. And throughout this 2010 period, we were averaging about 7%. And right now we're averaging, since 2023, no growth in prices. But we look at it, it's a 20% drop from the not even 20, nearly a 30% drop. Sorry, here it is. Here's the drop. A 20% drop in pricing that we haven't recovered from in regards to the latest drop. And again, why is that? Well, we were at interest rates that were at 7%. We are now getting out of that period. So we're going to be looking, once that excess inventory gets eaten up and off the market, we'll see pricing jump again. Because what we're going to have come back to the market is we're going to have demand come back to the market. And why are we going to have demand come back to the market? Well, we're going to have people that have been sitting on the sidelines just waiting for rates to come down. That's number one. Number two, we have people that are going to be able to buy now that couldn't buy before because they just couldn't get approved for the mortgages. Now with interest rates that have come down, now they actually can get approved for mortgages. So that segment of them will be back. And then the biggest segment of all the new Canadians that have come to Canada over the last 1 to 2 years will start buying real estate. Why are they going to start buying real estate? Well, they don't want to rent anymore. They don't want to rent. Their main goal in regards to relocating to Canada is to establish their economic presence. They don't want to be paying some other landlord and getting them rich. They want to buy real estate and grow their own wealth. These are all I shouldn't say bubbles. These are all demographic categories that are going to be happening in the next 2 to 3 years. So what did we see? We saw pricing go down 20% in 2022. There's been no price increase in 2023, 2024. Historically, after a price drop in a period of stagnant growth, we see prices jump, as we saw in this graph. Yes, and I see some put up their hand. All questions I'll answer at the end. So future supply issues coming up. Okay. So as I said earlier, we had things that are impacting the pricing right now in the market is that we have high interest rates, but at the same time we have high interest rates, we have also a number of properties completing. So this is a graph in regards to looking at completions, and we just came out of 2024, and we had over 32,000 completions in 2024. We're going to have another batch of big completions come in 2025. What starts happening after 2025? These go down, down, and down, 2026, 120. And that's including the red. And I have something very important to tell you about the red. So if we factor in the red, which hasn't started construction, so if it hasn't started construction yet, it's not finishing in 2026, I'll tell you that. And then same thing, 2027, 2028, 2029, 2030. If you look at this trend and we remove the red, which again, I'll tell you, these reds aren't getting built. These reds, we're down to 5,000 completions come 2028, 7,500 completions in 2027, and no completions come 2029. And why won't these projects in red, construction not get started? And they won't start because new condo sales at 30-year lows. So no one's buying new properties, new construction condos, which means dun, 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 there's no buildings being built. So this black line here, you need to sell 70% of a building in order for a builder to get construction financing. Builders can't get construction financing because they can't hit the threshold. If we look at since 2004, since 2004, buildings hitting construction financing, it's off a cliff. No projects that are currently on the market are anywhere near hitting their construction financing marks. And that's not coming back in 2025. It will not come back. It will not come back until the excess inventory in the resale market is eaten up. And then we start seeing prices increase on the resale market. And if we go back here, okay, well, what year we are? We're in 2025. Okay. So none of these red is being built. No, none of these red are being built because they haven't started construction yet. It takes 5 years from initial sales for a building to be completed. 5 years. And what does 5 years brings us? It brings us to 2030. So we have no new buildings completing come 2029. Nothing. No new condo buildings. There's not. So all those cranes you see, there'll be no cranes come 2029. You may have some purpose-built buildings being built, but no new condo buildings are completing in 2029, 2030. But what's still happening during that time? The population is still growing. The GTA population of 2030 is projected to be 8 million people. We're currently at 6.8. Sorry, we're not. And in 2023, we're at 6.8. In 2024, we're at 7.1. We'll be at 8 million in 2030. But there'll be no new completions for 2 years at that time. In 2029, no new buildings. 2030, no new buildings. So we're going to go from a glut very quickly to a huge, huge supply issue for properties. There is nothing being built. So again, if you look at things today, we are in a down part. We are at the down part of the market. But if we've expanded over a 5-year period and look at what's actually going to happen, there are going to be issues in a relatively short period in 2 to 3 years, and definitely in 5 years. So what does that mean to everyone here? How can you take advantage of this opportunity? Especially, again, it's if you are an expat, if you have American dollars, there is huge opportunity to purchase Canadian real estate looking at, well, I know that historically the average exchange rate is going to be 80 cents and we're at 70 cents. So I can buy Canadian real estate, which is also depressed right now, and I can double my return. And also I can then leverage that because I can put a mortgage on the property. So I want to give an example for that. So condos that sold for $700,000 in 2022 are now selling for $500,000 in 2025. And the average growth was 7% from 2010 to 2020. So if I purchase a condo in Canadian dollars for 500,000, which if you asked to do that in 2022, we would have laughed at you because you couldn't do it. Now, today, you can buy 1-bedroom condos for 500,000. Hey, guess what? Remember that first condo that I told you about that I bought, that my first investment? amazing unit. I just sold it for $480,000. 1 bedroom, door, window, perfect layout. You can buy those right now for 500,000 or under. If I look at the value of that in USD, that's $350,000 today. And the down payment for that in Canadian, 35%, because if you're a non-resident, just using a non-resident example, your non-resident mortgage would be 35% down. So in Canadian, that's 175,000, but in US, that's $122,000. If I do a 7% compounded annual growth rate, that brings me to 700,000. That just brings me back up to the values of 2022. So if I buy today and at 7% growth, I will get back up to the values of 2022. But at that time, if we look back, if we're at the average of 0.8%, I'm also seeing a jump in the appreciation of the property. So my gain in US dollars ends up being 161. So I invest 175 American today. I'm going to have a gain over that 5 years of 161, resulting in an ROI of 92%. So I invest 122 American. No, I messed up my ROI somewhere, because my gain would be higher than 92, because my gain in USD is 161. So it's actually greater than 90. It's over 100% ROI on that. But the great news is it would probably be around 100% when I factor in land transfer tax and various other costs. So actually my net ROI would still be 100% when I factor in selling costs and land transfer tax. And that's how you can double your and hedge your investment using US currency right now, taking on the double play of this, getting into historically low exchange rates, and also buying in the dip of the market, showing that yes, real estate prices are down today, but why are they down? We look at why they're down. Well, we just went through the quickest increase in interest rates ever in the history of Canada. That impacted the value of real estate, which obviously it would. Now that interest rates are coming down, we have a growing population. We have no new properties that are going to be completing in 2029, 2030. What does that mean? That means exponential price growth in the future. Now, I'm sure everyone has questions after all my rambling. So what I want to do is open up the floor. This is also the first time Nish and Kyle have seen this presentation. There's our beautiful faces. Hey, guys. Let's discuss this more. Again, I love it. Like when I look at those, for the spelling mistakes, sorry for those, especially sorry to Kyle. Like that stuff drives Kyle up the wall. You know, seeing the wrong there, the wrong week. So I apologize for that, Kyle, and I apologize to the spirit of Mr. Goddard, who was our English teacher in high school. Kyle and I went to high school together in Sudbury. So I know there was someone that raised their hand earlier. So if you want to ask your question in the Q&A box, Kyle, Nish, while we're waiting for people to populate. Oh, there we go. First question, but did federal government ban foreign investing to 2027? So foreign investing cannot happen even if Canadian dollar is cheap. No, Ricky, they banned foreign buyers, not foreign investment. So glad you brought that question up. There was never any foreign buyers. A foreign buyer, the definition of the Canadian government is someone sitting in another country that has no tie to Canada. So what is that? That means I'm sitting in, let me pick a country. I'm sitting in Brazil, because I just don't want to pick the regular countries. I'm sitting in Brazil. I'm like, Canada sounds like a good place. I'm going to buy something there. But you're not a Canadian citizen. No, I'm just going to buy there. Well, no, that's illegal. But if I'm in Brazil and I'm a Canadian citizen and I'm working in Brazil, I can still buy in Canada. Like I can make money in Brazil and buy in Canada because I'm a Canadian citizen, or if I have my Canadian PR status, I can still buy in Canada. It's only for foreign buyers. I can still transfer foreign funds to Canada. I can still do all that. So it has no impact in regards to expats, non-residents, from buying in Canada. As long as you have Canadian citizenship, as long as you have PR status, you can buy in Canada. It's just for the foreign buyers that are not allowed. And there was never a significant proportion of foreign buyers in Canada. A great question. Great question. Kyle Nish, do you like? I'll even give another example. So we have a good friend, Kyle's in the group as well, university buddy. He lives down in Atlanta, and I said, and he used to live in Canada, and he said you should be picking up something in Canada right now. He's an example. He works in the U.S., but he's still a Canadian citizen, so he can buy something in Canada even though he's lived in the U.S. for a decade. Doesn't matter. He can still buy something in Canada. I have other clients right now. They're buying something in Canada. They're in their mid 50s. Why are they buying something in Canada? Like, well, we're going to probably come back in 5 years. We'll come back to Canada once I retire, and we want to buy ourselves a place today. And this is actually what, if this was in January, I'm like, oh, like my concept, yes, you're actually doing it. And I didn't think of doing it. He's like, Alex, I'm only doing this today. And he wasn't even about real estate prices. I'm doing it today because when I look at the currency exchange is really in my favor today. So I want to move money back into Canada, and I'm going to move my money back into Canada into real estate because that makes sense to me. So you have all these expats that are in their 50s that are going to retire, and when they retire, they will come back to Canada. Why will they come back to Canada? Their kids are here. Their kids. The Middle Eastern expats. The expats that moved away in the 80s from the oil patches in Alberta to go work in the Middle East because they're getting huge amounts of money. They're all in their 50s right now. All the engineers, all the thousands of the engineers that are in the Middle East right now, they will not retire there because guess what? Their kids are not there. Guess where the kids are? The kids are back in Canada. The kids came to Canada to go to school. Now their kids are here getting jobs. That is happening right now. And all those expats will move back to Canada to be close to the kids. They'll buy, and this is, for example, in the Middle East, they'll buy a property in Dubai and Abu Dhabi because they're going to go back there and visit, but their primary residence when they retire will be in Canada. So you have all these individuals that are going to be repatriating their funds over the next 5 to 10 years as they retire, because they're not staying in the countries that they've been working in because their kids aren't there. Kids aren't staying there. Kids are back in Canada. Oh, questions are flying in now. Okay, so question about mortgages because they're a senior and they have a fixed income. Do you have any advice for seniors to get a mortgage or refinancing or approve? What you're looking at in those cases is working with your mortgage broker for advice. If you own multiple properties, and again, I mentioned that I sold one. Like, Alex, you say never sell, never sell. Sometimes you sell, but you sell and then you buy some other things, and then in this case that's what I did, and I sold my oldest property, which is under rent control. So at times you may want to balance your portfolio. If there's a difficulty getting a mortgage on one end, maybe you're going to sell something from your portfolio because that makes sense to balance out the portfolio. So there are times you sell, and I call it active management of my portfolio. But when I give the example, I want people to buy and hold properties. It's just that's the simplest way to do it. But at times you are going to sell properties from your portfolio. So my question would be is reach out to me. Let's look at the overall portfolio, and maybe we need to sell something from the portfolio to get you approved for a mortgage on something else. Another question coming up. Based on today's market conditions, how would you pick between Calgary versus GTA? Has Calgary Pre-Con been put on pause just like GTA? So what I would say to that is that the Calgary Pre-Con prices are in line with resale values, where the Toronto Pre-Con prices, there's a significant gap between the resale prices and the Pre-Con prices. And the reason for that is that builders just can't build for less here in Toronto. So you have this gap, and that gap won't come back until you have the resale market, the number of listings in the resale market come down. So also, okay, second part of this question. So yes, Calgary pre-construction, things are still selling in Calgary pre-construction because you don't have the same price concerns. In regards to, do I have any concerns for the Calgary real estate market due to Trump's tariff on oil and gas exports? I never got, like when they came out with this sheet, that said the city's most exposed to the tariffs. I have no idea why Calgary was up on top. Because it's yes, I think it was there because a large part of the market is based in oil and gas. So that their GDP, which that is true. But there's a massive asterisk beside that. All the growth in Calgary has nothing to do with oil and gas. So when we started promoting Calgary investment in 2019, that was pre-COVID. So oil and gas was where oil and gas was. It was the growth in the market, the growth in the other industries that had nothing to do with oil and gas. So even with the increase in oil and gas today, it has had no impact on the Calgary economy because there's been no expansion of oil and gas in Alberta. There's been no new oil sands built in Alberta. There will be no new oil sands built in Alberta. All the people that were laid off in the last bust period that happened in Calgary, which was 2014, 2015, 2016, they were never hired back. So even with a 10% tariff going on oil, it's going to have zero impact on the Calgary economy because anyone that was laid off, there's no one to lay off because there's been no expansion of oil and gas. All the growth in Calgary has nothing to do with oil and gas. Now, what I also want to add, when you actually look at the big picture, the US refineries are built to process Canada's heavy crude oil. So, and we've had the completion of the transatlantic pipeline, which has also increased our market, which allows our oil to go to international markets as well, which will help dull the tariffs on oil and gas. Can we just sell oil somewhere else? So it's not going to have an impact on the real estate market at all. Calgary. Kyle, Nish, you have any comments on that one as well?
I think you covered it.
Okay. I think I did too. What about bringing on USD foreign or domestic investors to invest into development projects? I'm currently raising capital to fund missing middle development projects. Yeah, absolutely. Like you can do the investment I like owning assets. I like owning assets in my name. You can also raise money, and if you want to fund real estate development and attract American capital, absolutely, and you can do it on that basis. Any way on how you want to bring money into Canada, I just always like owning the physical real estate asset as opposed to investing in a fund. That's what I've always promoted because when I invest in a physical real estate asset, I own it. I control it. I can do whatever I want. If I want to sell it, if I want to refinance it, take capital out, there's a liquidity to it and a predictability to it. And I can attach a revenue stream to it, which is the rent on the property. So absolutely, you can do raise money in a fund. And I've thought of it myself in regards to creating my own fund to start investing in real estate for individuals that don't actually want to own physical real estate because those people exist. People just like, hey, I'll give you capital and you grow it. I don't need distributions. Just give my money back some point in the future. Let's see it go up in value. So that I've thought of doing a fund as well. But I just like owning things in my own personal name to answer that question. But any way to bring money in the country, yeah, it just you can apply that to anything in Canada. You can go buy a company in Canadian funds if you wanted to, and you're going to benefit from the exchange. I've just always liked owning the physical real estate in my name or company I control, and then getting the rent. It's that simple of a process. Any other questions here? Or anything you, Kyle, Nish, you want to add? But I'm incredibly excited about where I see, like, what's the Warren Buffett? Be greedy when other people are, or what was it? Fearful. Oh, guys, lots of fear out there right now. Let's get greedy because that's where when we look at I'm showing 5 years. I am showing 5 years from today, 2025 to 2030. What's going to happen in 2025, 2030? If we look at that 5-year block. Well, I showed that the population of Toronto is going to increase by 8 million. Also, if we go into Calgary, so Calgary, much lower prices, population in Calgary is going to grow faster than the population of Toronto. Population in Calgary is going to grow by 62.5% by 2043. Going to add 1 million people over that period of time. So Calgary, same growth, even better growth projections. But let's go back to what we see. So we see population of Toronto increasing to 8, Greater Toronto area increasing to 8 million. So that's check one. Check two, what do we see? Well, check two, are there new buildings being built? No. 2029, 2030, no new buildings are going to complete. So check one, population increase. Check two, supply issues. Check three, okay, when I look at historic exchange rates, we are in a low period, so that will go up. So check three, we actually got a bump on the exchange side. Something again we couldn't talk about for the last 15 years. And then let's check four. Are we in a depressed market? Check four. We're in a depressed market. So the opportunity is there when you look at the 5-year period. Don't look at today. Look at the 5-year period of where we're going to be. Great question. Also from a real estate agent as well. Any concern with the landlord and tenant board? No, I don't. And why have no concern about the landlord and tenant board? Here's a great thing. If you're scared of landlord and tenant board, just go buy in Calgary. No issues with landlord and tenants in Calgary at all. There's no rent control in Calgary. There's fixed term leases. At the end of a 1-year lease, you want to tell them to go, you tell them to go. Non-payment of rent, you'll get the guy out in a month. No issues. It's landlord friendly in Calgary. If you don't like Ontario, go to Calgary. You'll get everything you want. Why I'm not concerned about that stuff in Toronto is that if you put the proper screening checks in place, you're not going to have an issue with the tenant. None. And all you do is you look at the credit score. And when I say look at the credit score, you run your own credit score. So you got to run your own. Don't rely on the credit score that a tenant gives you. Never do that. You run the credit score. You validate employment. You check references thoroughly. We go to the extra level of checking all their social media profiles as well, so to validate all information. You do all that, your tenant's going to pay, because in that process you're going to hit a red flag if there's a red flag. So we don't have an issue with tenants not paying at all. And also when you're looking at condos, which specifically I'm talking at condos, you're especially in Toronto, you're attracting a different demographic as well. If you start going into, I own apartment buildings in Hamilton. If I own apartment buildings in Hamilton, yeah, I will, I may end up with someone that stops paying rent. That's a possibility. But it's a different demographic you end up renting to in those cases. But again, if you do the right checks, you're not going to have an issue with collecting rent. So that mitigates the risk of having someone that's not non-payment of rent.
Also, Alex, to that point with vetting your tenants, there are professionals that can help you. Like we have professionals that help us vet the tenants. They review employment information to make sure it's a valid company and it wasn't a forged document. So if you are concerned or have questions, always go to the professional, because they go through every layer of due diligence to make sure that who they find for your property is fully vetted, and you can feel comfortable with the process.
Correct, absolutely. I'll like if you go put your place on Kijiji or Facebook Marketplace, and then you rented to a rando, and you just relied on all the documents and didn't do a background check, could you end up with someone's not paying rent? Absolutely. But if you go through the proper process, will you end up with someone's not paying rent? Highly, highly, highly unlikely that happens. I haven't had it happen to like in my own personal portfolio. I haven't had it happen to me. Kyle hasn't had it happen to him. Nish, has it happened to you? Hasn't happened. And I'll knock on wood. Let's knock on wood here. Let's. I don't want to get too aggressive. But again, if you do the right steps, you're not going to have that being an issue.
And I actually had a bit of a hiccup in Calgary with one of the tenants, but because we use professional property managers, they know the laws, so they can utilize the tools that are in their disposal to make sure that the tenants pay rent. And if they're problematic, as Alex said, within 3 weeks you can have them on.
Yeah, it's not an issue. So again, like if we look at, okay, Alex, we like what you're saying, you know, where do we invest? Again, you have two options. You can invest in Calgary. What does Calgary have to offer you? Well, it has much more favorable landlord terms as a province, and you're buying at a much lower price point. And also a deposit as well. So if you're buying pre-construction in Calgary, you're looking at a deposit in the 10% range. And of that 10%, when you're buying in, let's say, prices between 350 to 500,000, you're looking at a deposit of 35 to 50,000, depending on what you're buying. So, or if you're buying in Toronto, you can buy in depressed market. Oh, and also no closing costs in Alberta as well. You have closing costs here in Ontario. On Ontario, I'm dealing with a more depressed market in Ontario, which may have higher upside in regards to a future rebound, but I'm going to be dealing with some costs up front. But I see an opportunity across. And that's when you look at it, you take a 5-year picture, not a 1-week picture. That's the key thing to look at. And then Julie Nish will message you the property management company he uses in Calgary in the question chat. So thank you everyone for coming and listening to me. And Nish and Kyle, something we truly feel passionate about. I see great opportunity. You just got to take a longer look at it. The massive, like if you know someone that is living in the States, living in the Middle East, living in Hong Kong, living in Singapore, living in any country that's not Canada, making American dollars, I would put them in touch with us because there is tremendous opportunity to redistribute their capital, repatriate their dollars. Again, they have to be Canadian citizens, repatriate dollars into Canada because of where we are with exchange rates and where we are with our real estate market. So again, it's all about taking a big picture look. Thank you everyone for coming in online, and this has been recorded. You'll get a copy of it, and looking forward to further discussions and you guys booking calls with us. Okay, thanks so much, guys. Talk soon. Bye-bye.
Bye, everyone.